Well, I know you talked also about the idea of, seeing risk and, what's your perspective on that of how folks think about risk that they're taking on?
Yeah, so seeing risk is a very interesting one because there's a lot of risks that people can see right away, but then there's a lot of what I call invisible risks, risks that people don't immediately see. And there's a fascinating story from World War II about this from mathematician Abraham Wald. And so what Abraham was contracted by the government to come and help bolster bomber jets and figure out where should we put the armor on these bomber planes. And so what they were doing before Abraham came in was they saw the bomber jets come in with holes in the wings and the fuselage, and they said, okay, there's tons of holes in these places. This is where we need to put the armor. They can't put armor over the whole plane because it'd be too heavy and then it'd fall out of the sky. So this is where we need to reinforce the planes. But it just kept happening. They still were having the same loss rate of planes. And then Abraham came in and said, you're looking in the wrong place. You need to look at where the holes aren't, because those planes aren't coming back from battle. So what you need to do is reinforce the engines. And so that's a term called survivorship bias. So if you look at the success stories, and you hear a billionaire talk about how his business was successful, and maybe he did hit some speed bumps along the way, but ultimately those didn't derail the business. I'm sure that's helpful in a way to listen to, because success is also helpful to listen to, but often it's the failure stories that tell us more information about what risks we might not be thinking about and what risks we need to plan for.
Yeah, and I love that. That's a great story, and it depicts it quite well. And I know something from some of the prior days that we used to work at, we used to lead the enterprise risk office for a major Fortune 100 bank. And one of the things we used to talk about there was how do we design the risk strategies? Because the whole idea there is a certain heroism to rushing in and solving, putting out the burning fire. We'd rather just have the sprinkler systems and the escape stairways instead, so you don't have to lose the whole building in order to be a hero. And designing those risk mitigation strategies can be a key component there.
Exactly, because there's some risks that are a little bit harder to plan for. So everyone in the founder world is very familiar with the risk of not finding product market fit, and that does derail a lot of businesses. But then there's all these other invisible risks that you don't think about that we can plan for, like you just said. So that could be things like planning for the key people in the business, making sure that if something happens to them, the business keeps running. Can include things like over-concentration of equity, can include things like sequence risk, liquidity risk, lots of other ones as well.
I love that aspect of it. And when you talk about things like sequencing and, as we look across, going from that accumulation phase to having a comprehensive planning system, time horizon sequencing, other things factor in there. Talk a bit more about that.
Yeah, so some of the things that I would consider there in terms of that is founders tend to overlook certain things that should be present of mind. Some of those things include how the decisions they make over time are going to affect their equity, their taxes, and their concentration risk. And timing of those activities can vary greatly. So whether you're exercising options or having a partial exit or another liquidity event or doing a secondary sale, all those things, depending on the timing you do them, will have vastly different effects on your taxes, lifestyle, and just the return. So those are things that I would think about.
That's another great observation. Just earlier today, I was having a call with someone that was being invited into a bit of a general partner type of role into a fund. And as we were taking a look at some of the documents, one of the interesting things there was it said that there had to be a 75% supermajority before any decision could be made. But when we looked at it, if there was going to be these two primary partners involved, there was no way that the minority partner was ever going to get above a 20% stake in the business. So effectively, while it read well that there was going to be a supermajority vote, there was no way that the primary was ever going to be unable to veto any direction of the business.
Right, yeah, strategically written.
So there's those kinds of things to look at and understand, how does that get impacted, whether it's by dilution over time or the next funding rounds and all those kinds of things of saying how our decision's going to get made.
Yeah, exactly. And it's good to create simple guardrails along those lines, like for the buy-sell agreements, how much you can sell, when you can sell, how that ties back into the overall company strategy. So those things are affected all the time by situations like that. It's the way I would approach invisible risk in general is that you have to find a way to make it mean something for real people and make sure that you're identifying the risk beyond volatility. Volatility is a very familiar risk where you know that if you hold Apple stock, for example, that Apple stock's price could fluctuate depending on what's going on with not only with their business, but with the market in general. But it's good to distinguish the other risks that people don't think about. And that's, okay, you've got the risk of your company not being successful because of product market fit, but then you also have general market risk. Like if the sector that your company is in is doing poorly in the market, if there's like low confidence in that sector of the economy, then that's a risk that you realize as well. being in that sector. And then there's, as a founder, there's the concentration risk of you having all your eggs in one basket, assuming that it's your only basket. And then there's the liquidity risk of saying, hey, I'm worth this much on paper, but that much is not how much you're worth in practice. You can't just go and actually spend that net worth anywhere. Kind of tying into that is behavioral risk. Because you might be worth that much on paper, it might encourage you to have a more lavish lifestyle, which increases your business or personal burn, depending on how you structure it, and could cause you to run out of that excess capital quicker, and then ultimately lead to the failure of the business as well.
Absolutely. And I know one of the phrases we use a lot is, as we help folks think about that contingency planning, we talk a lot about, spend the 5% to protect the other 95%, because it kind of like the analogy I would use is like run flat tires. Technically, yes, I can let the air leak out of my tires because I've got, run flats, but at some point, even the run flats will give out. And so should I just have that capability to reinflate the tires instead of just counting on run flat always being the end solution there? And we do see a good number of advisors that may be a bit of the strategy is I'll just keep running on dead tires until they fall off the rim.
Exactly.